It may be years too late, but Europe has boosted its stimulus program, hopefully better late than never. The ECB will spend 1.1 trillion euros, 60 billion a month until September next year and beyond if necessary. Here's my updated comparison graph. The European program is small beer when you compare it with Japan, where the size of the central bank's balance sheet or stimulus program will be 80% of GDP by next year. Europe will be 30%. Deflation is a real concern in advanced economies. This is OECD inflation, excluding energy and food. It's barely above 2%, even with all the stimulus packages. The red line tells you there's not one advanced economy with inflation above 4%. But stimulus is to equity markets what liquid fertiliser is to pot plants. Share markets were in full bloom everywhere. Most rose at least 1%. So the Australian market has capped off a pretty good week. The death of Saudi King Abdullah encouraged investors to buy energy stocks because a change in leadership might mean a cut in production and higher oil prices. There was a lot of action on currency markets as well. The euro hit a fresh 11-year low against a strengthening US dollar because of the stimulus. The Australian dollar's also tanking against the greenback, hitting new 6-year lows. Offshore, they think we're about to cut interest rates because a lot of other people are. And while the US dollar has gone up against the Australian currency, the prices of imported goods are still falling. Some of that would be oil, but it also suggests that higher prices from a weaker dollar can't be passed on to consumers. Weak economy, falling inflation. If trends like that persist, we will be joining the rate cut club, and that's finance.